So you did it?
Yep.
All right, I'm gonna start recording. You guys are free to start.
All right, everybody, welcome to our monthly Cannabis Lab educational program. We have a great one for you tonight. A lot of the folks, or two of the folks here on the screen, have been in C Lab longer than I have. They've been very influential in my career, and they're very, very smart people. Two people that I text very often to get information whenever I need it. So with that being said, we're going to keep the introduction short and sweet. Our next event is going to be what today is. Today is the 22nd. So it'll be on Thursday, the 29th. We'll be live from the Ackerman office in Fort Lauderdale on the 10th floor. That is going to be awesome. It is an outdoor venue. Hopefully the weather at night has been a little bit colder, so it should be super enjoyable. It'll be a lot of fun. So definitely check that out. If you guys want to join C Lab and see some more of this great programming, you can check that out at joinclab.com. And of course, last but not least, we want to thank our sponsors for tonight's event, S2S Insurance and Ackerman as well. So they've been long time sponsors and supporters of C Lab, so we can't thank them enough. With that being said, tonight's topic of alternative risk strategies for cannabis companies is being led by our very own Rahn. Eric has been around much longer than I have. He is one of the most knowledgeable people that I know in the industry. And again, is someone that I go to when I need information. So without you guys seeing any more of me, Eric, the panel is yours.
Thanks, Todd. Thanks for that introduction. My name is Rahn, Managing Director of S2S Insurance Specialist and co-founder of Alternative Risk Strategies, a captive advisor company. Today's webinar is an advanced dive into the risk transfer alternatives available in the cannabis, hemp, and auxiliary related industries. The subject deals with both large and medium-sized public and private companies. We encourage questions from the audience via chat, and please direct your questions to one of our panelists. You can also connect afterwards with any of the panelists. You can find them on LinkedIn, or we've provided their contact details in the chat room. Our approach to today's subject will start with a brief introduction by our panelists on their area of expertise when evaluating alternative risk transfer for the cannabis and hemp industry. Let me first introduce our panelists. Steve Monacelli, CPA, cannabis practice leader at Withum. Zachary Coburn, cannabis law specialist and outside counsel at Ackerman LLP. And John Magliano, attorney and co-founder of Alternative Risk Strategies. Before we begin, I want to throw out a disclaimer. There are many forms of captives, and the one illustrated tonight is one example of a specialty cell captive program. I'm going to provide a quick overview of a captive example based on a multinational, meaning Canadian-US public company with major US revenues from an MSO vertical operations. Then we're going to let our panelists take us into a deeper dive on the subject of captives as an alternative risk transfer for cannabis companies and how the rules presently apply. And I want to make sure that everybody understands this is how we would look at a captive today. Things, as we know, could change overnight. And maybe we'll get into a little of that discussion as a little later in our presentation as what if some of these laws change. So with that being said, I'm going to present, can everybody see my screen? I believe so. A brief overview of what is a captive. Captive is a unique insurance company set up by its business owners to insure its own specific company's risk. Captives are an effective way to take financial control, insurance, allocations, manage risk, and accumulate wealth. Captives should be used as a supplement to existing commercial coverage and underwrite unobtainable coverages. And we'll get into that in a moment. But again, a captive goes hand in hand with some of your commercial coverages. With traditional insurance company, the insured and its shareholders collect premium and retain the profit. A business-owned insurance captive has a unique ability to manage, assign, and script specific risk. And that's where we're going to take a little deeper dive a little later this evening. A captive with little or no claims builds up equity within the captive for future use to reduce future premiums and distribute back to the company. So that's a 3,000-foot view of what a captive is. Here's a good example. We have a Good Fortune Seed Company, a good profitable company, and they're exploring, they want to open a captive. So this is how a captive would work. Good Fortune Seed Company would hire a captive advisor and its outside professionals to do a feasibility study to analyze if Good Fortune Seed Company should form a captive and what risk the company possesses that it wants to transfer into the captive. The captive insurance company is the issuer of the policy and obtains reinsurance from, in this case, AM Best Rated, and manages the captive and the claim. And what happens is a Good Fortune Insurance Company is formed. It's a special purpose insurance company, 100% owned by the company's independent board and managers. So what happens is Good Fortune Seed Company pays tax deductible premiums to cover insurance risk. And Steve's going to talk a little about this phrase here because it's a little different for a cannabis company. Premiums are received tax-free by the captive insurance company. The captive assets grow, funds are reserved for potential claims, and upon liquidation, the assets are transferred back to the owners. And once this structure is formed, Good Fortune Insurance Company insures all the uninsured risks as outlined in the policy for Good Fortune Seed Company. Risk pooling. In order for a captive to be legal, it needs to show transfer of risk. So how does that happen? Risk distribution occurs when particular risks are combined in a pool with other independent insured risks. Pooling is one of the tools a captive utilizes to build more stable underwriting portfolio and optimize the overall effectiveness of the risk management program. So here we have Good Fortune Insurance Company. It is then placed in an unrelated pool of participant captives. So now we have critical mass. And from there, this pool goes out and buys reinsurance to sit over the pool to pay for any catastrophic events. The client benefits the diversification of unrelated party risks, smooths losses over time, and lowers potential impact of a single costly claim. The benefits of an insurance captive. Self-insurance captives coverage not obtained in the commercial market. So what we're going to talk about are things that cannabis companies find are difficult to obtain, such as, or costly, such as D&O, product liability, crop insurance, losing a major supplier, supply chain interruption, are just a few of the examples that you can insure under a captive. Ownership control of the captive insurance company. You control and determine your risk. Only insurance that risk you want to accept. Other risks are insured through commercial insurers. Access the reinsurance market with benefits such as increased capacity, lower pricing, coverage benefits, and reduced exclusions. Insure difficult risks, improve control over losses, and less expensive reinsurance for higher limits. There's flexibility in premium payments, resulting in improved cash flows, capital accumulation with clean loss records, and insurance captives have a quick underwriting process and document turnaround. So I know that was a lot of information really fast, but again, we're assuming this is an advanced class in captives. So in summary, a captive market is a captive market is for the sophisticated risk taker, including both buyers and sellers of insurance and their professional advisors to work together to develop non-traditional methods of financing risk. For those who form or use a captive and have made a choice, have analyzed their risk financing options, and have the financial ability and the will to invest in their own resources to benefit this type of risk financing program. We will discuss why insurances are willing to invest capital, and insureds are willing to invest capital, take risk, incur direct and indirect costs to use captive insurances. Please welcome our first panelist tonight, Zach Kobrin, partner at Ackerman LLP, one of the largest law firms in the country and the first big law firm to have a dedicated cannabis practice. Zach has been a general counsel for 2 publicly traded cannabis companies, specializes in transactional and regulatory matters, and advises clients on a number of issues, including improving their insurance and risk management policies. Good evening, Zach.
Thanks, Eric. Happy to be here.
So let's jump right in. What are some of the problems cannabis companies currently face when it comes to obtaining traditional insurance policies?
So I think first and foremost, the obvious one is because of the federal illegality with cannabis, that there are either a number of types of insurance policies that are not available or they're too costly. For example, many typical insurance companies will not offer insurance in the cannabis sector because of the federal illegality. So what that ultimately means is, you look at supply and demand, supply is low, which means costs are high. Ultimately, it comes down to it's difficult for many cannabis companies to obtain quality and cost-effective insurance. When you look at the lack of availability on insurance, some of the things that come to mind are products liability or crop insurance. For those that are growing cannabis, being able to insure your crop, say, against a fire, against a flood, against a storm, against, a crop failure would be, that is your assets. Operating without that kind of coverage and protection is a huge factor. So I think the lack of availability because of the federal issue, the lack of insurance companies offering products and the cost are just some of the issues that cannabis companies face when it comes to obtaining traditional insurance policies.
Okay. So let's discuss a little about the analysis the cannabis company needs to make when comparing captive costs versus traditional insurance, and why captives may be a good alternative. And let's talk a little about cost of risk.
Sure. So for those types of insurance policies that are available for cannabis, there are certain policies that are just exorbitantly expensive, more than other similarly situated industries. So for example, for publicly traded cannabis companies, so those on, say, NASDAQ, New York Stock Exchange, or most of the plant-touching operators in the US that are in Canada, obtaining directors and officers insurance coverage is extremely expensive. You could have companies just for D&O insurance pay anywhere from $1 to $2 million to $5 to $7 million in premiums a year. So one of the benefits that we've always looked at when it comes to the potential of captive insurance or any kind of private insurance or risk retention pool is, at its simplest core, the idea of the concept of a captive is you're using your money to insure yourself, and in the doing so, you're letting your money make money. So Whereas with most insurances, you're paying into something and you will not see your premiums back. When it comes to captives, you can use that as an investment opportunity. John Doe Cannabis Company, instead of paying $5 million in premiums for its D&O insurance, has the opportunity to put that in an investment fund and let that money make money. And that's how you insure yourself. So there is definitely a potential economic benefit in the sense that you have cost savings over traditional insurance policies. I think it's also kind of important, Eric, to talk about maybe the concept of bridging the gap between available insurance policies. One of the things that you touched on early on was that captives are not a fill every hole, but rather fill the holes you've got. And what I mean by that is the market is not set up in the sense that you can completely self-insure every insurance you need, but rather it's segmented. So directors and officers type liability insurance, general liability insurance, property insurance, crop insurance. One of the great benefits of a captive is that you can use a captive to fill the gaps where you can't get good insurance. So you may have a great broker who's going to obtain for you a great general liability and great property insurance, but you may not be able to get products liability coverage or crop coverage. Well, if you're a cannabis operator, say in Florida, and you're selling, $5 million worth of vape cartridges every year, you're liable to a claim. Vapes are some of the biggest product liability issues in the industry. So if you can't obtain reasonable, cost-effective, but high quality insurance, you can look at a captive as potentially filling that gap. It's an opportunity for, I would say, companies to take control over what kind of coverage they want, whether it's more or less at at the level with which coverage they want.
Okay. So in order for a company to form a captive, what kind of due diligence is required to determine if you should pursue a captive risk program? What's the feasibility study in the background? What's a company really need to pull together to even get past the first base here?
So it's honestly not as much. It's a big lift, but it's not as much as like if you're a cannabis company and you've ever done an acquisition. It's not much more than that, really. You want to have a clear understanding of your leadership structure and your infrastructure, right? You want to have it clearly defined who does what in your company, who's in charge of what in your company, and how the process works. When the research is going to be done and you're going to be digging in, things like having a clear org chart, for your company ownership, for your leadership. Being able to identify, Eric Rahn is my CEO and this is his bio and this is what he does. Also having clearly defined board and officer structure. Being able to know, hey, here's my board of directors. They are these type of people. Person A is this qualified. Person B is this qualified. Here's their background. But also here are my officers. Here's my chief financial officer. Here's my chief production officer. Here's my chief marketing officer. Here are all my people, and this is how my business runs. You have to be able to portray that you've got not only a going concern of a business, but a business that's well structured and well run. Additionally, you're going to want to be able to identify your ownership structure. And by that, I mean, say anyone more than 5%, when you're structuring a captive to go into, they're going to want to understand where your money is coming in, kind of like when you're doing due diligence with a bank. They want to know where the money is that's coming in. It's going to help fund all this and help fund your operations. Additionally, on the financial side, you want to have strong financials. That means, and you don't have to have audited financials, but you've got to have, a regularly prepared financial statement and also financial projections. These are going to be extremely important because it's going to help define for the facilitator and the administrator of the captive how much risk you can really afford, how much risk management you actually need. Ideally, underwriters, will like to see cash on hand or access to funds to cover cost of liabilities, debt repayments, expenses, say over the next 12 to 18 months, maybe 24, but 12 to 18 is probably ideal. And something that most companies don't actually understand what these are, but you can get it from your broker, is what's called loss runs, which is, in the simplest terms, it is a formula that insurance companies use to determine a ratio, a proportion of how much cost to apply to the losses that you've applied. So for example, if you have a labor and employment claim and you're a cannabis company and you've been hit with an employment matter, the longer that lawsuit goes on, the higher your loss runs go on. That brings up your insurance costs. It's kind of like when you get car insurance and you have more automobile accidents or more tickets. Think of those kind of as loss runs. They increase your rates. It helps determine the value of your risk, that which an underwriter is going to set a value to. So you're going to want a clear and updated loss run report. You're also going to want to have a full understanding of any open litigation you've got that affects your insurance. So if you've got a securities claim, if you've got a labor, especially as you're focusing on the captive market that you're focused on. So if you're dealing with a D&O captive, you're going to need to understand what are any potential claims or lawsuits someone's brought against your officers, your directors, securities claims, things like that. One of the other things that's really important is your financial support. Any underwriter, whether it's with an insurance company or a captive administrator, they're going to want to know what your current banking relationships are. Whether it's with traditional banking, non-traditional banking, any kind of investor groups or holding companies, joint venture capitalists, anything of the like that have a strong investment within your company. If they're providing capital, that's something you need to be able to identify. And then lastly, I would say is making sure you've got a strong team behind you, outside legal, accounting, auditors, insurance, and HR. All the areas that don't make companies money are the areas that are the most important when it comes to this type of thing. So that's kind of my 30,000-foot view of the nuts and bolts of it.
Thank you. And great overview. I mean, I think any cannabis company, we live in regulated industry. We need to make sure our houses are in order. And all these things that I think a captive would be looking for are pretty much the same as any investor is going to be looking at before they put money into your company. These are the foundational documents of a corporation. Our next guest, Steve Monticelli, serves as tax partner with Withum, a top 25 accounting and advisory firm with the expertise in providing tax planning strategies and forward-thinking solutions, particularly to firms in the cannabis and real estate industry. Good evening, Steve.
Thank you, Eric. Glad to be here.
Let's dive right in. What are the economic advantages of using a captive insurance and arrangements to mitigate risk as it applies to a cannabis industry company?
Excellent question. I want to just start out by differentiating types of captives because I think it's important. Captives come in really two delicious flavors. And I'm going to use code sections because it's pretty popular relative to what has been in the press. And when someone Googles captives, you'll see a whole bunch of IRS court cases on one particular type that haven't been too received by the Treasury as favorable in terms of risk shifting and risk distribution, which are two requirements that need to be met in order to take a deduction. Because we're really focused on deductions, and we'll get to 280E in a little bit. But first, we got to get through the bar of whether or not this is a type of self-insurance that we can take a deduction on. And the two forms are really an 831A, which is what we are talking about in this presentation. And then there is a form of insurance captive called an 831B, which is a micro captive. And a micro captive at this point, I think the Treasury has won so many court cases that I'm not seeing them be used as much as they were 10 years ago or so, because, it was a way in which people were forming an insurance company and they were the only customer with the insurance company. And the IRS has pretty much concluded that there's not enough risk shifting and distribution to really warrant a deduction into a micro captive. So when we're talking about captives in this program, we're talking about an 831A captive. And basically your risk is pooled with a bunch of other participants, and that excess risk is being reinsured, as Eric and Zach had mentioned. So I kind of look at 831A captives as almost like a co-op for captive insurance. If we really want to boil off the fat, it's really a co-op for, as Zach pointed out, instances where you have a difficult time even insuring certain risks like crop insurance. Many of our clients are not carrying crop insurance. And this is certainly a nice way to say, hey, wait a minute, we can self-insure some of this crop insurance and reinsure it and pay out some claims where appropriate. And make no mistake about it, in terms of determining levels of coverage, and Zach had alluded to a lot of due diligence, as part of a captive insurance strategy, there is an actuary that is retained as part of the captive execution to make sure that the proper level of insurance coverage is warranted given certain risks and levels of risk that are going to be insured in the captive. And the rest of it will be subject to a reinsurance. Let's talk about ideal candidates for captive participants. We look at captives, a lot of public companies have captives. They've had captives for years. And, to look at the challenges that cannabis companies have, somewhat different. I mean, for the most part, you can pretty much get any insurance you want in any other industry. In a federally illegal business, some coverages are very expensive, like D&O insurance, for instance, as Zach had pointed out. It's extremely expensive. And, we were talking a little bit off screen before we started this conference, and John was saying, how much D&O insurance has really increased over the last few years. But the perfect participant in a captive is a profitable business with seeking substantial tax deductions. And we'll get into 280E in a little bit and how it dovetails. But businesses with multiple entities, or those that can create multiple operating subsidiaries or affiliates, businesses with more than, say, $500,000 to $1 million in sustainable operating profits. So the risk in captives for cannabis, in my eyes, is that, markets mature. And as markets mature, when profits disappear, you may no longer have the level of cash available to pay for premiums for certain levels of insurance. But unfortunately, once we are in a captive, there are certain administrative costs that need to be met every single year when you become part owner of a captive insurance company. And really what we're talking about here is forming an insurance company to which you are going to own a piece. And so basically that is your methodology of self-insurance. So you basically have started another business that will accumulate wealth by, having premiums collected to which perhaps don't get repaid out in expenses and or reinsurance costs or claims. And that value continues to appreciate. There's an opportunity to receive dividends. And at some point in time, when you expect or want to cash out of this captive insurance, the percentage ownership of this captive, the captive would be valued and you would take your distribution and you'd be taxed as a capital gain on any excess of proceeds in excess of what your cost basis was. A captive insurance for tax purposes is really a C corporation. They operate as a C corporation, but they have certain insurance related type opportunities. For instance, when a captive collects insurance premiums, it has the ability to take a tax deduction to reserve for losses for the participants. So in that respect, when you think about it, if, for instance, you can write a check, let's say it's for crop insurance, so that I know it's attributable to inventory. And so you're eventually going to get a deduction against your gross income when you sell the inventory, and the insurance cost will be included in that. And then the captive receives the proceeds, and the captive's going to take a deduction for loan losses or insurance loss claims. And essentially what the captive will pay tax on is really its investment income on the reserves that it maintains. And so when you look at it that way, it's kind of like a nice tax hedge, provided you've got a scenario where you've got some of your captive premiums being able to be included in your inventory cost. So let's talk about 280E. We've all heard about 280E. If you're joining us today, I'm not going into the definition of 280E. I'll spare everyone the details. But the bottom line is you can't take a deduction when you are trafficking in a Schedule 1 or 2 substance. And bottom line is, although you can't take a deduction, what you can do is take a reduction of your gross income to determine your taxable income by way of your cost of goods sold of your product. And if you've got a cultivation facility or a manufacturing facility, you've got the use of some inventory regs in various court cases that tell us what we can and cannot do with respect to including cost and inventoriable cost. It's a great mechanism for us to reduce your taxable income. So I spend a lot of time in those regulations relative to what we can include in inventory cost. And these regulations were written in the early 70s when a lot of manufacturers were just trying to take tax deductions at the end of the year for inventory purchases that it didn't sell. Well, lo and behold, the IRS comes out with a very sophisticated set of regulations still in existence today. And it's the panacea for cannabis companies to really have some kind of an adjustment to their income so that they can reduce their taxable income. So when we talk about captive insurance, we actually have to dive into the nature of the insurance and the related premium and determine whether or not that can be includable in inventory cost. For instance, crop insurance is a layup. That is clearly something that relates to the inventory. On D&O insurance, I struggle in a way in which I have a difficult time trying to figure out how to include that in inventoriable cost. So when you've got a cannabis company participating in a captive, you're really going to have an array of deductible and non-deductible insurance costs. But that's no different than you going out and buying this insurance from an independent provider. The dispensaries, unfortunately, is where most of the trafficking occurs. And the dispensaries are really bound by a different set of inventory rules in that they can only take a tax deduction for basically their landed inventory cost. So if we were trying to insure the contents of a dispensary, it's a little difficult to associate that with the inventory cost. In terms of being able to take a deduction in the first place, we talked about risk shifting and risk distribution. And as Eric had pointed out in that illustration, you're going to have a number of other participants in the pool. And that's where the due diligence comes in that Zach was referring to make sure you've got candidates that have similar risk profiles so that everyone's sharing in a pooled risk together. And that's pretty much the economics, Eric, behind captive insurance as I see it, as it dovetails into 280E.
Thanks, Steve. Appreciate the explanation. Our third speaker tonight is John Magliano, an attorney and co-founder and co-founding manager of Alternative Risk Strategies, also my partner. Widely recognized and respected tax attorney, general counsel for public and private companies, and international mergers and acquisition attorney for over 36 years. John has served as the executive committee of the Oregon State Bar Tax Section and was co-founder of the Oregon State Bar Cannabis Section and served as its chairman. Good evening, John.
How you doing, Eric?
Good. Good. How are things up in the great Northwest?
It's the most beautiful time of the year. Thank you for
Excellent.
asking.
Excellent. So, John, what industry should we consider using captive insurance? Because not only are we talking about THC touching companies, but we have hemp, we have a lot of non-THC touching companies that do business within the supply cycle of cannabis. So can you kind of break it down for us? What kind of risk are we looking at?
Well, the industries that should really consider using captive insurance without specifically enumerating them, it comes down to a couple of simple things, several simple things. First are industries where insurance is relatively expensive or hard to find. And I think most importantly, you not only have to have those two criteria, but you also need to have the potential for the insured to effectively manage its business so that it can reduce risk. And the last requirement I think you have to have is that you should have a history of doing so. If you don't have what Zach was referring to as a loss run record, so that we have some idea of what your risk profile is, it's going to be very hard for a captive manager to place you into a captive. We need to see how your company is doing so that we can make any changes we need to its operation or other risk profile. And so I think the two most important things are the ability to effectively manage the risk and the history, having some history to show us what the losses were. I think that really describes the cannabis and the psychedelics business in my experience.
Okay. Can you give us some, Steve mentioned that captives have been around for a long time, and most big industries use them. Can you give us some examples of those industries that meet those kind of criteria in a hard market?
Sure. I think that it is important to look at the industries that have used them effectively for a long period of time, because one of the interesting things when you go around, captives are being thrown around a lot in the cannabis business finally, due to the history of insurance. But there's a lot of industry. It is not a new concept. And I think it's very useful to see the stability and really profitability that it's brought to certain traditional industries in which they're very popular. The first is the construction industry, and the second is the transportation industry, where captives have been widely used for many, many years. I've represented many companies in these two sectors. Both of these industries can effectively manage the risks associated with potential losses. In construction, for instance, worker safety programs have greatly diminished on-the-job injuries. Worker management education with regard to new construction techniques, materials, et cetera, has improved the quality of the completed projects, so less construction defect issues. And integrated scheduling software programs have reduced waste and led to more projects being completed on time, which reduces the delay penalties. So I'm just trying to give some flavor here of the kind of industry, as I alluded to before. You can see that they've identified the risks that they can control, which are really primary drivers of loss failure if you're operating correctly. And these were very effective. In transportation, things like routine scheduled equipment safety inspections so that there's not so many accidents. Tire and braking issues are huge in that industry. Driver schedule tracking software to monitor hours driven and drug screening have all led to tremendous loss reductions, making it worthwhile for these companies to enter into, if not individual captive arrangements, certainly within their own industry with like group captives. There's also emerging industries that are now showing a good potential for the use of captives. And I think today's major focus is on the cannabis industry. This would also apply, I believe, to hemp to a great extent. And I think we all know that obtaining insurance, as we've gone over here today, Zach's covered it well. The insurance for the business risks associated with cannabis companies is either extremely difficult or impossible, like with crop insurance for outdoor grows, which doesn't even cover pests or pathogens. It's very difficult to get and very expensive or both. The premium cost for cannabis company D&O insurance has stabilized somewhat, as we know, in the last couple of years, but it's still extremely expensive, making captives potentially very attractive. At a cannabis company that I was general counsel for 8 years, we initially paid $25 million of insurance. The premium was $175,000 in 2005 when I took them public. Then a couple of years later, the same $175,000 bought us only $10 million. And finally, in the last few years, it got up to $250,000 plus per million. So you can see that that's putting a lot of hurt on the cash flow and the ability of the cannabis companies to manage their costs and risks. In the cannabis sector, there's many reasons for the increasing cost of these premiums. I believe it was Zach that went over a few, the supply and demand. That's certainly true. The federal illegality, certainly true. But there's also been in the United States a historically high incidence of lawsuits relating to corporate governance. For instance, when I was general counsel, there was a cottage industry that was formed that took a look at press releases that were and were not issued by cannabis companies. And there were many lawsuits relating to things that investors believed should have been disclosed to the market that were not. And it got very expensive. There's also investors and product liability issues, as was pointed out here in the cannabis industry. And then cannabis has unique workforce issues. However, as I pointed out, these risks are all manageable. And because they're manageable, I believe it makes it very worthwhile for cannabis companies that generally have good operations and a good loss record to consider captives. There's also the psychedelics industry. That's really an exploding industry. Many people are looking at as an alternative investment to cannabis. The use of psilocybin-based treatments and medicines is definitely an emerging area, but there's risks associated with that industry, including psychedelic companies, officers, and directors can be sued by investors for mismanaging the business in connection with fundraising activities and for potentially permitting the company to manufacture an inherently dangerous product. That's just pretty much like any food company, except in this case, we have the added hallucinogenic potential effect and the other effects of psychedelics. Psychedelics are typically distributed as a consumable, as we know, raising the same issues faced by other consumable products, except there are inconsistencies in government regulation and compliance with respect to psychedelics, and quality controls could make product recalls and claims defense increasingly challenging. If you can manage those again, captive seems to be a worthwhile endeavor. There's also environmental, social, and governance issues, which are increasing in psychedelics companies, just like they are in cannabis. Company management, impacting risk management more than ever before. All these big issues are being faced by the psychedelics industry, and they're going to start facing air and contamination, chemical discharge, and other improper disposal issues, all of which can be controlled, making captive potentially useful. There's also technology. We know that new and unproven technologies such as digital art, non-fungible tokens, NFTs for short, and these personal avatars where people's entire financial and other history is located and used, pose risks of loss for insurers, the magnitude of which are difficult for the insurers to quantify due to the nascent state of the technology and its implementation, as well as the lack of data on the types of events that are associated with losses in these technology areas, for instance, digital fraud and counterfeiting, which still goes on despite the fact of these technologies. And the last one that I'm really going to talk about has affected a lot of industries is the lack of cybersecurity or non-affordability of cybersecurity protection. This has resulted in massive losses to insurers, which has been in the press. End user failures are attributable to a lot of it. The failure to update security patches or install and update best-in-class security software has led to a dramatic decline in insurers offering cybersecurity insurance. Captive insurance may make sense for companies implementing best-in-class security, Eric, if they update their software regularly and consult with cybersecurity specialists to protect sensitive data. So the bottom line from this sort of emerging market and the traditional history that we have that's proven that captives are very worthwhile when properly managed is that a company has to be able to effectively manage risks. I know I'm repeating that, but it's the most important thing. I've been a general counsel for private and public companies for over 37 years and have participated in billions of dollars of transactions and financings, with over 250 million being cannabis cross-border deals. But neither I nor any client of mine has ever been sued in connection with any transaction or financing or related to any breach of fiduciary duties by the officers or directors. So of course, there's luck involved, and I like to tease that, yeah, I might be lucky, but I'm not really that lucky. It is a process of risk assessment, which is due diligence, mitigation, and most importantly, follow through. When you've figured out what the risks are, how you can mitigate them, it's not enough to know that. You got to follow through.
So, John, many of the larger cannabis companies are listed on exchange in Canada and have operations in the United States. Are there any insurance issues that arise from cross-border business operations of these companies?
There are, Eric. Many of these larger companies, unless they are a Canadian cannabis company that has substantial cannabis operations in the United States, they're going to be obligated under law to be insured by what's called an admitted Canadian insurance company. That's just a company licensed to insure in Canada. The failure to use an admitted Canadian insurance company can result in the imposition of fines, the amount of which is dependent on the province in which the Canadian company is organized. So there's different potential penalties there. There's a limited exception I'm not really going to get into about going around, and if you get a certain amount of declines, that you can use a non-admitted policy or insurance company. But there's a number of Canadian companies that have shown a propensity to pick up almost any risk for cannabis companies.
So what constitutes substantial operations in the United States? If I'm a Canadian public company, but I really don't do business in Canada, I'm an MSO operator in, let's say, 3 or 4 states, and I have to be vertically integrated. And so let's say all my revenues formed here in the United States. What happens then, and how does it apply to the captive?
Okay, well, if there is substantial business operations, then you can use a U.S. insurance company or with a U.S. captive, with a U.S. insurance company. And so by doing that, you're able to cover the rest of your operations, which are not in the United States. So as you asked, the important inquiry is what constitutes substantial operations in the United States. And while I'm unaware, Eric, of any definitive ruling or guideline on the percentage or dollar amount of business a Canadian cannabis company has to do in the U.S. to meet the substantial threshold, I feel comfortable in saying that if the U.S. operations generate a majority of the revenue of the Canadian company's business, or if the majority of the company's employees, plant, and equipment are located in the U.S., this should qualify as substantial. As to what percentage below more, the majority will constitute substantial operations, I think that's open for discussion. But I also personally believe that 40% or even 30% of the revenue or employees, plant, and equipment in the U.S. may meet the substantial threshold, especially if the officers and directors of the company are U.S. based.
Okay.
Hey, Eric, isn't it worth having the conversation, though, that if you are a Canadian public, at least for D&O insurance, you need to cover the Canadian base because of the Canadian public entity?
So what will happen is if it's a U.S. company writing the policy, they will insure the Canadian holding company for and its securities operations. So to move things forward, John, last question for you is, as a general counsel for public and private companies, do you believe that there's a greater risk to the officers and directors of a public company?
Well, generally, I do believe that's true because there's a greater risk, first of all, because the risks to public company officers and directors are magnified. They're magnified typically by the size of the company's business operations, the required disclosures that you have in order to be public to your investors, the exchange, as well as various securities regulatory agencies. You also have the need to observe good governance procedures. And the number of interested parties like governmental agencies, exchanges, independent auditors, investors, lenders, et cetera, scrutinizing the required disclosures, you've got a lot of people looking at you. So appropriate insurance levels are critical for the officers and directors of both types of companies. But public companies typically carry higher insurance amounts. Consequently, if the business risk is manageable and the company has a good loss history, there is potentially much more insurance premium savings and capital accumulation for the public company through the use of a captive insurance program.
So in closing, then, it makes sense to kind of look at a captive structure. If I'm going to start saving myself 30-40% year over year, that saved money can go really into, beefing up my compliance efforts and my operations and putting in a risk compliance program that kind of keeps me on course from trying to make too many mistakes. Guys, in closing, Steve, you got any closing comments you want to react to any of the other panelists?
Actually, it's interesting. I like the conversation that's directed in terms of D&O insurance and why it's so expensive. And I think it stems from the fact that when you think about this is the gold rush. Okay, state after state, we're seeing state legalization. We've got bills in the House, the Senate relative to safe banking, some form of legalization. And when you look at this, everyone seems to be looking at the cannabis industry as a fast-growing, opportunity for rates of return to investors. And when there's a disconnect between expected results and actual results, that when you're expecting a large rate of return and that rate of return may not be there for whatever reason, whether it's 280E, operational issues, there is a high propensity for disgruntled investors in some enterprises. Not all, but definitely some. And I think it's probably more prevalent in the cannabis industry because of its high growth rates and its fast moving pace, whereby there can be some disconnects in expectation versus actual results. And I think that's why there's a high potential for, investor lawsuits against the board, whether it's a privately owned company or a public company. And I think captive insurance is a nice solution to be able to self-insure part of that risk, because I'm finding a fair number of our clients are not covering D&O. And I just think it's a tough recipe, and that can be a regret out of the box when something happens.
So Zach, in your experience, have you seen any claims in the cannabis industry, or can you kind of expand on maybe some of the issues that have come across your desk as a general counsel for a cannabis company? Unmute your mic there, Zach.
Sorry. I think, sure, the bigger you are, the faster you're going to get hit with a securities case. Disgruntled investors, there's always going to be firms that are just shopping around doing class actions. Products liability claims are huge, especially on the hemp side. I would say from a claims and a captive side, the way I usually explain it to people is, if you're willing to take a risk and let your money make money, it's a good opportunity because you're insuring your risk and providing a payment for it. But from a claims perspective, it's like any emerging growth industry. Most cannabis companies, even the biggest ones, they operate like startups. So there's going to inevitably be problems, which means there's potential vulnerabilities. So.
Okay. John, last word. Unmute your mic there, John.
I think, can you hear me now?
Yep.
Hello? I think that anyone that is even considering a use of an implementation of a cannabis captive ought to really think about doing an audit anyway, even if you might not be ready now. What that will do, will provide a baseline for you, and a good captive manager can help you with some of the risk assessment policies and procedures, and helping your company to improve its risk loss record or keep it low, so that when it comes time to implement the captive, that you will be in a position to make it successful.
That's a good summary. Well, thank you, everybody. Appreciate your insight. I hope this panel was insightful for people who are considering captives. Again, you can contact any of us. Our names and contact information is in the chat box below. And again, thanks for joining us at C-Lab, and I'm going to turn it back over to Todd.
All right, everybody. That's all we have for tonight. Everybody, thank you and have a good night. Join us next week at the Ackerman office on Thursday, the 29th at 6 p.m. Join CLab.com. Good night, everyone.
Good night. Thank
Good
you.
night.